Did you know that many of the doorbuster deals featured on Black Friday are sold at a loss? Yet these same retailers see their most profitable quarter of the year right after? Today, we're dissecting the retail industry during Black Friday, a period that regularly drives over $65 billion in US sales in just a single weekend. Over 150 million Americans shop or browse on Black Friday each year, making it the single most critical moment for both big box chains and online giants. Retailers like Walmart, Target, and Best Buy dedicate months to strategizing for this shopping blitz, deploying everything from limited-time deals to high-stakes marketing. Most people believe Black Friday is all about getting unbeatable deals, snatching up TVs at rock-bottom prices, checking off holiday gift lists, and beating the crowds for bargains they simply can't find any other time of year. The surface value proposition seems clear: massive discounts for the consumer, thin margins for the retailer. Understanding the true economics behind Black Friday unravels why retailers can afford to slash prices, how they turn loss leaders into profit engines, and the subtle tactics influencing your shopping decisions. For consumers, this offers vital insight into where the real savings are and aren't. For investors, it reveals how short-term losses convert into long-term gains, driving stock price valuations and shaping holiday profit forecasts. The core driver of Black Friday revenue is product sales, with a particular focus on high-turnover categories: electronics, toys, home goods, and apparel. The average cart value surges during Black Friday, often 2 to 3 times higher than regular shopping days. In 2023, US Black Friday online spending topped $9.8 billion in a single day. Beyond immediate sales, retailers generate significant secondary revenue through upsells, extended warranties, and product bundles. Loyalty programs collect valuable customer data and fuel future marketing. Some retailers also negotiate marketing allowances from manufacturers to feature their products heavily in Black Friday promotions. Here's the twist: many deals, especially on big brand electronics, are funded partly by manufacturers themselves, who subsidize the discounts for retail placement. Additionally, capturing customer data for retargeting, email campaigns, and future holiday cycles quietly adds long-term value. Some stores even profit from unredeemed gift cards, which surge in sales during the holidays. On average, over 60% of Black Friday event revenue comes from core product sales, 15% from upsells and add-ons like warranties and accessories, around 10% from vendor cooperative advertising and placement fees, and the remaining percentage derived from gift cards and data leverage. Despite the buzz around headline deals, this deeper understanding is where the real magic happens. The vast majority of actual profits come from full-margin and high-margin add-on products, not the doorbusters. The expense side during Black Friday is driven by cost of goods sold, with many items deliberately sold at or below cost. Extraordinary seasonal labor outlays, heightened marketing expense, logistics surcharges, and extended operating hours. Marketing alone can spike 2 to 3 times for Q4. Many costs, such as store leases and basic IT infrastructure, are fixed, but most Black Friday expenses are highly variable, scaling directly with sales volume. Inventory, temporary staff, and surge logistics all jump with demand. These variable costs are tightly managed to maintain some margin on the busiest days. Shrinkage, losses from theft, skyrockets during Black Friday, sometimes doubling compared to the rest of the year. Customer acquisition and retention costs are masked by the flash sale, but retailers pay heavily through returns, refunds, and future discount expectations created by promotional pricing. Despite the seemingly thin deals, retailers average gross margins of 20 to 25% during the Q4 holiday window. Margin on loss leader items can be negative, yet baskets are engineered so that full margin accessories and impulse purchases offset these losses. Compare this to normal gross margins of 30 to 35% outside of the holiday period, highlighting that Black Friday is a carefully engineered trade-off. Black Friday pricing isn't random. Retailers deploy loss leader pricing on doorbusters, slashing prices below cost to draw in crowds, while relying on value-based and psychological pricing for accessories, extras, and less promoted items. Tiered discounts and Was Now pricing emphasize urgency and perceived savings. Retailers segment customers by product. Steep discounts on select loss leaders attract bargain hunters, while softer markdowns or full prices catch less price-sensitive shoppers. Bundling, e.g. a discounted TV with a pricey HDMI cable, exploits price discrimination, and loyalty members might receive exclusive early deals or deeper discounts. Scarcity cues, limited quantity, time pressure, today only, and cognitive anchoring Was $799, now $399. Push customers to act fast and inflate the perceived value of the deal. Research shows that 60% of shoppers buy more than intended due to Black Friday urgency tactics. The thrill of winning a deal outweighs rational judgment. While core Black Friday deals run as much as 40 to 70% off comparable in-store prices, many ancillary products are marked up, offsetting losses. Online-only retailers like Amazon use dynamic pricing. Prices shift hourly based on demand. Some brands quietly raise regular prices pre-holiday, making discounts seem deeper than they really are. The typical Black Friday journey begins with aggressive advertising and email teasers, prompting store visits online or in person. Doorbusters serve as the hook, while store layout and online algorithms steer shoppers toward margin-positive products. Post-purchase, loyalty programs and retargeting ads aim to turn one-time bargain hunters into repeat customers. For consumers, the promise is simple: the year's lowest prices and unbeatable deals. For retailers, the deeper value is the acquisition of new customers, liquidating aging inventory, and priming the market for the holiday shopping marathon. Convenience, immediate gratification, and event energy underpin the customer experience. Major chains wield scale, negotiating exclusive deals with manufacturers, investing in marketing blitz campaigns, and leveraging supply chain efficiencies to undercut smaller competitors. Data aggregation around shopping patterns enhances targeting precision, further reinforcing their competitive edge. Retailers optimize inventory with predictive analytics, automate restocking, and orchestrate high-volume logistics. Customer flow is strategically managed to direct traffic toward profitable zones, both in-store and online. Many even pre-package bundles for speed and higher ticket averages. Retailers' brilliance lies in marrying loss leader deals with psychological pricing and sophisticated cross-selling. Leveraging real-time data analytics, they optimize every touchpoint, turning a festival of discounts into a tightly managed profit machine, where the illusion of massive bargains masks the reality of engineered profitability. Loyalty programs, proprietary store credit cards with layered rewards, and app-exclusive flash deals lock in shoppers. Post-Black Friday, personalized offers and points encourage return visits and larger lifetime value per customer. Holiday events are stretching into longer periods. Black Friday night blends seamlessly with Cyber Monday and week-long sales. Some retailers experiment with in-store events, live-stream commerce, and exclusive memberships to drive year-round engagement. International expansion is turning Black Friday into a global retail phenomenon. The Black Friday model faces threats from margin compression as customers become more deal-savvy, regulatory scrutiny of deceptive pricing, supply chain disruptions, and rising competition from online native retailers. Overpromotion can erode brand value and train consumers to wait for discounts. First, loss leaders aren't just about selling cheap. They're calculated bets to drive profitable add-on sales. Second, psychological pricing transforms discounts into behavioral goldmines. Third, retailers who win Black Friday master both the art and science of profit orchestration, balancing headline deals with hidden margins. Beware of strategic upsells. And remember, if you don't need it, it isn't a bargain. Use price comparison tools and be aware that the best deals may only apply to narrow product categories. For investors, strong Black Friday execution can signal operational excellence and brand strength. However, beware over-reliance on promotions and thin long-term margins. A retailer's lasting value lies in turning seasonal spikes into year-round loyalty and data-driven growth. Black Friday reveals how powerful the combination of loss leadership and psychological pricing can be. When applied thoughtfully, they anchor customer acquisition and drive record sales volumes, but rely on operational discipline and brand management to protect long-term profitability. Next time you see a jaw-dropping Black Friday deal, ask yourself, is this really a bargain or a masterclass in retail psychology? As e-commerce matures and AI-driven personalization evolves, expect Black Friday's tactics to spread year-round. Retailers will focus more on unique experiences, deeper loyalty incentives, and smarter data leverage. But price compression and consumer skepticism will demand ever more sophisticated playbooks. So when the next Black Friday ad blitz hits, look past the hype. The real bargains are often in the business models, hidden in plain sight. For our next episode, we'll unpack the economics behind airline ticket pricing, why your neighbor paid half as much for the same seat, and how airlines turn pricing complexity into profit.